Just a refresher from our last meeting. We went over the naked put, amongst other things, but just wanted to kind of just do a quick review on what we went over, and so hopefully it'll help you with the other strategies and things that you're doing in the meantime. So first off, remember we talked about the naked put is simply like the insurance company does to us all the time. They sell us a naked put every single month. If you have car insurance, you are actually paying for a naked put insurance company. This is how they actually generate income and make a lot of money from from you. So what we're doing now is basically saying, okay, I'm going to flip the script on them, and I'm going to become the insurance company, and I'm going to sell premium and to people on the market. And basically, that is what a naked put is when you're looking at this option strategy. Think like an insurance company. Now, just a quick review for some of you who might be watching this who do not have car insurance or never had car insurance. Every single month you pay a premium. We'll say $100, and it goes directly to the insurance company. Insurance company receives this premium and income, and basically they have this little piece of paper that says you are insured. Now, this agreement only lasts for 30 days, so it's a 30-day option. Okay. Now, you have, as the buyer of this insurance, have the right but no obligation. Seller, the writer, the insurance company, has the obligation. And you've heard that before, but we're going to use it in a different way here. So you pay the $100 in January, you pay the $100 in February. They receive it, you're driving, everything's fine. May rolls around, and you basically have some little damage to your car. The damage was $450. You're not going to report that to the insurance company because you have a $500 deductible. So it doesn't really make sense to report that to the insurance company because you still have to pay $500 for them to go back and fix it. Doesn't make sense. But what does make sense is this. Remember you paid the $100 to them, and then they have and then the deductible is $500. So your actual break even, or when you want to exercise your option of them paying for the damage will have to be well over $500. Well over $600 because you got to add the premium you did pay. So your break even is $600. If the damage is, say, for $800, you would have to pay the $500 deductible. You already paid the $100, and you have an insurance company turns around, they pay $200, and they've been receiving this $100 premium from you for like, well, how many years? So basically, the buyer has the right to say, yes, I want you to pay for it, but not the obligation. They can say, you know what, I'm not going to report this to the insurance company. Don't want my rates to go up. So that's where that have the right, but not the obligation. With a seller, if you go to them and it's past your deductible, they have the obligation to fix your car. So in the insurance company world, that's how that works. Now, let's get into the trade that we went into, which was WYNN. WYNN was trading at $58.37. We decided to sell a naked put. So we became the insurance company. We sold a naked put. Now, basically what happens here, we received $2.18. The contract's for 100 shares. So that basically means our total premium was $218 for one contract. Implied volatility at that time was 81.47. The most important number that we need to remember now, and what we're going to go over, is the implied volatility. And hopefully this will give you a little bit more information on how implied volatility works. Now, the risk. The WYNN must fall to $47.82 before the stock is put to me, before the buyer of the option, which gave them the right to sell me the WYNN, it would have to drop down to $47.82. Reason, if it drops to 50, even though they have the right to sell it to me at 50, doesn't make sense to them because they paid for that right, and they paid $2.18. So technically it has to get to $47.82. Just like the insurance example, your deductible is $500, but you've already paid, and you paid $100 in premium. So to exercise, the damage would have to be more than $600. Now, calculating the break even, we already went over that. So simply, it's the $50. Of course, I'm doing this without commissions. So it's the $50 because if you're paying a dollar commission, which you can be, which a lot of people do, or you're paying $9 or $7, you'd have to calculate that, within this. But we're saying we're going to do these calculations without the commission. 50 minus the 218, $47.82. But the real thing is this. Remember, the stock was at $58, so it would have to drop from 58, down $8, then to 2. So that gives you a lot of room, and that's what the insurance companies do. They calculate this out, make sure they have enough room that they're going to be successful month after month. Now, but this is the part of the implied volatility that a lot of people don't know and or probably don't understand, but it is calculated on most of the websites or your online broker. We're taking the 48.37 and the 58.37. So what we're doing simply is we want to calculate what the implied volatility tells us what the stock should be trading for in a certain period. So I got 30 days here, 7 days, and even 1 day. And all of this is going to work, and I want you to see how. $58.37, then we multiplied it by our implied volatility, and it basically said that the next day, or the 1 day volatility, or the market should move, expected move, is $2.97. So if you take that, I'm going to show you the following day or the next day on this particular stock was $61.12. So $2.97, we'll call it $3 plus the 58 is roughly $61. And then 61.12 is what the high was for the following day. Let's look at the 7 days. And when you calculate the 7 days, it says $6.55. We look at the 7 days and we add the 655 to the 58.37, and 7 day was at 63 and the 8th day was at 65. So basically it's a really good indicator on exactly what's, to help you out on deciding when to make the change. So lastly, on the 30 days, since it's not 30 days will happen this week, actually Friday, I wanted to give you a little background here. Look what happened in October. So you can see the top here, can't really see what the price is there, but we can rough estimate of 75 down to 60, 75 down to 47, 73 here down to 60. So what you've seen is that this 1366, that this implied volatility said this is what it should go to, it's not far off, and it's basically taking this information from the past to predict the future. So we just basically put it into our trading. So anyway, so that's it. So hopefully we're going to add a couple more to this so we can start adding spreads to this so that you can actually understand how understanding the naked put first and getting your head wrapped around it is good, and then we can kind of go from there. So I'm going to shoot another video out there, and it's basically going to show you step by step how to find the particular stock to actually use or create this naked put.